All right, my friends, we got problems. And we need to address this. So, I was reading an article on LewRockwell.com, L-E-W Rockwell, and this guy had written this, and man, I don't disagree at all, and I've been saying this for a while now, but I'll show you. So we got real from 1989 to 2024. The real median income, remember, real means net of inflation. Median means a 50% point. Half is higher, half is lower. You don't want to look at averages here. You always want to look at median if you can. Has average grown by 0.662% a year above inflation. So less than 1% a year above inflation. On the other hand, from the same time frame, the S&P 500 has grown by 8.8% a year above inflation. So that's well above a 10-to-1 difference there between 1989 and 2024. In fact, if we go back to 1979, where was it here? 1979 to 2024, real median income has grown by 0.3% above inflation. S&P 500 has grown by 8.67% above inflation. And it's going to get even uglier. Check this out. If you are making $1,000 in 1979, you're making $1,144 in 2024. You've beat inflation, mind you. You've increased your wealth by your income by $144 above inflation over that 45-year time frame. On the other hand, if you put $1,000 in the S&P 500, it's worth $50,000 now. So it's a 50-to-1 ratio versus a 114. I don't even know what that would be. I just want to point that out again. $1,000 invested in the S&P 500 is worth $50,000 today. $1,000 of wages is paying you $1,144 today after 45 years. 1999 to 2024, real wages went up by 0.6. S&P 500 went up by 5.8. So you can see that 25-year time frame, S&P 500, because the aughts didn't do so well over that 25-year time frame, and the real wages did better relative to the 1979 to 2024, 1989 to 2024. Actually, not 19. Well, anyway, no, I guess it didn't do better than 1989 to 2024. But you can see there's still, even in that case, the S&P 500 did significantly better. Over the last 5 years, real wages went up by 1.5, and the S&P 500 went up by 11. And that's the best we have, other than we're going to get to some older numbers here in just a second. Anyway, so I want to point out, the richest 1% own 50% of all equities, and that does not include mutual funds. These are directly owned. The richest 50% own 50%. The richest 1% own 50% of all equities. And that's directly owned. That does not include indirectly owned, including mutual funds. I didn't confirm that, but okay. Even if that wasn't true in terms of this is non-directly owned versus directly owned, I don't know, but that's what the guy had written, and I trust that what he's saying is correct. But either way, 50% of the equities out there are owned by the richest 1% in the United States, all right? There's less than 1,000 billionaires, and they own around 10% of the entirety of the U.S. equity markets. The poorest 50% own less than 1% of the equity market. So the richest 1% own 50% of the markets. And again, I assume that's not including mutual funds and ETFs because it says directly. And if you own an ETF or mutual fund, you don't own that share directly. The poorest 1% own less than 1% of these stocks. Now, I would argue, and you could probably make an argument here, if we're going to do the same thing, directly versus indirect, these probably people own more because of indirect holdings in mutual funds and equities. I would think that'd be right. Either way, the richest 1% own the majority of the equities that are out there. The poorest 1% certainly do not. So that's the poorest 50% certainly don't come close to that. That's the wrong answer. All right, so now let's go to 1950 to 1979. All right, so you get what am I doing here? Oh, right here. 1950 to 1979, we had real wages grow by 2% a year versus 7% a year in the S&P 500. 1950 to 1979, that's a 30-year time frame. Yeah. Real wages grew by 2% a year. The S&P 500 grew by 7%. 1960 to 1979, real wages grew by 2% a year, and the S&P 500 only grew by 2.5%. Isn't that interesting? 1970 to 1979, real wages grew by 1%. The S&P 500 was down. Anyway, the point being is, even with this market decline in the 1970s, from 1950 to 1980, essentially, the S&P 500 still grew more than 3 times this, but the real wages grew as well. So why do I say there's a problem? What are stocks based on? They're based on earnings. How do you get earnings? You get earnings by selling products to people. Who are these products you're going to sell it to? Well, you got to sell it to Americans because we have the biggest pocketbooks there are. If American wages are only growing up by 0.662, are you going to be able to continue to get that 8.8% real return? I just don't see how you could, and I don't. And that's why I use in I was just talking to a guy today. He's got his money at Vanguard. That's why I use a very low rate of return, because I just don't see how you're going to get those earnings that we've come accustomed to justify assuming an 8.8% real rate of return that we've had since 1989. Or an 8.6% real rate of return that we've had since 1979. I just don't see how you're going to get that. Real wages need to grow, and growing by less than 1% a year while the markets grow by 8 and 9%. At some point, and especially when the rich own the majority of the equities out there, there is a segment of the population that's getting exorbitantly rich. And there's a segment of the population that's just barely beating inflation. And that just at some point, the consumer says, I don't have the cash to continue to consume. And if I don't have the cash to continue to consume, what has to happen for earnings? Does this mean it's a bubble? No. Doesn't mean it's a bubble. Does it mean the stocks are going to fall? No. I just think we need to get back to a more reasonable 2% real growth on earnings and a 7% rate of return on stocks. You can double your money every 10 years with a 7% rate of return on stocks. All right? You can do that. It has been done. I don't want to go here, 1970 to 1979. I don't want to do that either. But this is the model, 1950 to 1980. And actually, if you do want 1950 to 1970, it'd be better. But even that, 1950 to 1980, still even took into that decade of the 1970s. It did. And even then, we had earnings growth or wage growth dwarf that of what we have during the free market time. Anyway, so that's my concern. I don't know how you would model stock projections at 8.8% real if wages aren't growing with it. Now, you could make the argument, I somewhat challenge that, hey, but the last 5 years we've had real wages grow pretty well at 1.5. Is that going to continue? Well, hopefully Trump's going to get it going on, and it looks like we're seeing some of that. But I don't know, man. I don't know. I think we got problems that have got to be dealt with, and the problem is we're not making enough money for the workers to keep up with the rising stock market. Again, that K-shaped economy. There's something to be said about this. You sound like a communist. Oh, okay. Anyway, so something to think about. All right. God bless. Love your thoughts. Smash.